Wait, Germany quietly pulled 300 tons of gold out of New York. Turkey is adding more, China is accelerating, and central banks are hoarding reserves at levels unseen in over half a century. By the end of this video, you'll understand why gold could reach $10,000 and why that figure isn't speculation, but arithmetic. But first, you need to see the pattern, because it has repeated across every major monetary system. And it's unfolding again right now. At this moment, global debt has surged past $35 trillion, equal to roughly 336% of the world's entire annual output. The Federal Reserve's balance sheet didn't grow, it detonated. From $900 billion in 2008 to more than $8 trillion at the peak. At the same time, the dollar's share of global reserves slid from 73% in 2001 to under 58% today. And here's what they won't admit. Inflation wasn't temporary, it was structural. I'll show you why in a moment. Gold slipped quietly from $2,200 in 2018 to above $2,000 today. Major institutions are now running models that point to $10,000. The question isn't whether gold will reprice. The question is whether you understand why it must. Let me show you something that reframes everything. Every monetary breakdown in recorded history moves through 4 stages. Once you recognize the pattern, you can't ignore it. Stage 1. The foundation. A currency backed by something tangible. Gold, silver, real assets. Governments operate inside limits. The system works because trust rests on substance. Stage 2. Expansion and dilution. The limits become problematic. Wars need financing. Programs demand spending. So the structure shifts. Gold backing shrinks. New currency appears by decree, not production. This is the era of illusion. Prosperity without output, wealth without effort. Familiar, isn't it? We'll pinpoint exactly where we stand in this cycle shortly. But first, you need stages 3 and 4. Stage 3, crisis and loss of control. The illusion fractures. Prices rise. Foreign lenders get uneasy. The government doubles down on the very actions that cause the damage. More issuance, more debt. The currency unravels, sometimes violently. And gold, the only asset that has survived every prior collapse, revalues to account for the true scale of destruction. Paper wealth evaporates. Those holding gold endure. This pattern isn't theory. Let me prove it with 3 examples spanning 2 millennia. In January 1923, a loaf of bread cost 250 marks. By November, 200 billion. Before World War I, the mark was stable, backed by gold. Germany was an industrial engine with a credible currency. The war blew that apart. Berlin financed it with borrowing and printing. By 1918, the money supply had quadrupled. Then came the Treaty of Versailles. 132 billion gold marks in reparations, a burden no nation could meet. Germany had 2 options, default and face occupation, or print and postpone collapse. They printed. By 1921, inflation was raging. Workers demanded payment twice a day to spend wages before they disintegrated. By November 1923, the mark was dead. But those holding physical gold kept their purchasing power intact. Gold didn't rise. The currency collapsed beneath it. In 1933, Franklin Roosevelt issued an executive order that seized gold from American citizens overnight and devalued the dollar by 69%. Here's how the United States reached that point, and where that trajectory now leads. After World War I, America emerged as the world's dominant creditor. The dollar was anchored to gold at $20.67 per ounce, and the system functioned because the backing was genuine. But when Washington needed a larger money supply, the gold constraint became an obstacle, so it was weakened. Then came World War II and immense deficit spending. In the aftermath, Bretton Woods established the dollar as the global reserve currency, still tied to gold, but only for foreign central banks. That asymmetry guaranteed eventual collapse. The U.S. could print limitless dollars to finance the Cold War, Vietnam, and expansive domestic programs, while other nations were required to hold those dollars and trust the gold behind them. By the 1960s, outstanding dollars dwarfed America's gold reserves. Charles de Gaulle began redeeming dollars for gold. Others did the same. The gold window came under attack. The U.S. faced a binary choice: halt the printing and trigger recession, or close the gold window and preserve the system through confidence alone. On August 15, 1971, Nixon shut the window. For the first time ever, the global reserve currency was supported not by metal, but by government promise, from a government already drowning in debt. With gold fixed at $35 per ounce, the repricing was instantaneous. By 1974, it reached $195. By January 1980, $850, a 24-fold surge in under 10 years. The dollar survived, but at a violently lower real value. Those who relied on the system paid the cost, but this pattern is ancient. Consider Rome. The denarius began at 95% silver. 2 centuries later, it contained less than 5%. This is pure monetary debasement, and it shattered an empire. Under Augustus, the denarius was trusted across continents. Soldiers were paid in it. Trade depended on it. The coin worked because it carried intrinsic value. Empire, however, is expensive. Rome's armies and bureaucracy demanded ever more currency, but silver output couldn't keep up. Emperors began diluting the coin. Nero cut purity to 90%, visually unchanged, fundamentally gutted. As silver content fell, so did trust. Merchants rejected the coin's stated value. Prices detonated. The economy fractured. Soldiers demanded payment in goods or in gold, anything but Rome's hollowed currency. Between 235 and 284 AD, Rome cycled through more than 50 emperors, most murdered or killed in combat. Monetary collapse fueled political breakdown, and the political breakdown accelerated monetary ruin. In 274 AD, Aurelian tried to repair the system with a new coin, but the damage was irreversible. The economy had already shifted to barter, land, and gold. When Rome finally fell in 476 AD, those who held gold endured. Those who held diluted coins lost everything. 3 civilizations, 3 eras, 3 political structures, the pattern is identical. And what you're about to see explains why central banks are quietly moving gold, why Germany pulled back 300 tons, why China unloaded treasuries, and why the Federal Reserve is cornered. In 1944, Bretton Woods made the dollar the world's reserve currency, backed by gold. By 1971, that anchor was gone. Yet the dollar survived because of 3 forces: oil priced in dollars, overwhelming military power, and the depth of U.S. capital markets. The foundation wasn't metal anymore. It was confidence backed by force. After 1971, the United States gained the ability to print without restraint. National debt was $398 billion then. Today it stands above $36 trillion, a 90-fold jump in just over 5 decades. Between 2020 and 2022, M2 expanded by 40%. That wasn't growth. That was dilution. And Washington's response to every shock has been identical: more issuance, more borrowing, more spending. The 2008 crisis, quantitative easing, the pandemic, $5 trillion in stimulus, the 2022-2023 inflation spike. Blame supply chains, keep spending. Each response deepened the underlying fracture, and the symptoms are now visible everywhere. Here are the 5 critical signals. Signal 1, inflation. Brushed aside as temporary, it revealed itself as structural. Real wages slipped. Asset prices detached from fundamentals. Housing became unreachable. Signal 2, foreign creditor flight. China's treasury holdings peaked around 2013. Now they sit below $800 billion. Russia exited nearly entirely before the military conflict. They knew what was coming. Signal 3, the BRICS bloc. Brazil, Russia, India, China, and South Africa, now expanding to include Saudi Arabia, the UAE, and Egypt, are actively developing alternatives to the dollar. They're settling trade in yuan, rubles, and rupees. They're creating payment systems outside SWIFT. This isn't theory. This is policy unfolding in real time. Signal 4, central bank gold accumulation. Remember the 300 tons Germany retrieved, the 122 tons the Netherlands removed from Manhattan? Central banks added 1,136 tons in 2022, the most in 55 years. They're not buying gold for yield. They're buying it because it's the only asset that survives a reset. Signal 5, the debt trap. Interest on the national debt now exceeds $1 trillion a year, more than the defense budget, more than Medicare. The Federal Reserve is boxed in. Raise rates and crush the economy, or cut them and ignite inflation. There is no favorable path. Meanwhile, federal spending continues unchecked. Deficit spending surpassed $1.7 trillion in fiscal 2023. There's no political appetite to reduce it. There's no practical way to raise taxes enough to compensate. The only lever left is printing, which accelerates the slide into stage 4. This is where the system is heading, and the math is unavoidable. In a moment, I'll show you the precise calculation that proves gold must reprice to $10,000 or more. But first, understand this. The trigger itself is unpredictable. It could be a sovereign debt rupture, a collapse in confidence in U.S. treasuries, a geopolitical event that fractures the petrodollar, a quiet, coordinated move by creditor nations to stop funding U.S. deficits. But the specific spark is irrelevant. The structure is what matters. And that structure mirrors Weimar, mirrors Rome, mirrors 1971. The debt is unpayable. The currency can't be defended. The only endpoint is reset. Here's the calculation that reframes everything. If the U.S. attempted to back the dollar with its 8,133 tons of gold at today's price of $2,000 per ounce, it could support less than 2% of the M2 money supply. To back even 40%, the historical norm, gold would need to be priced above $10,000 an ounce. That isn't a forecast, it's arithmetic. And central banks understand it. That's why they're repatriating. That's why they're accumulating. That's why Germany, the Netherlands, Austria, Poland, Hungary, and many others have been moving their reserves out of New York and London. They're not positioning for turbulence. They're positioning for a reset. And you need to grasp something essential. This isn't a forecast. It isn't a warning. It's a description of a cycle that is repeated without exception throughout human history. Every fiat system fails. Every debt-driven currency reaches a point where servicing the debt destroys the currency itself. Every government that tries to print its way out of crisis speeds the crisis up. And every time, gold revalues to match the scale of the damage. The pattern doesn't care about American exceptionalism. It doesn't care that the dollar is the reserve currency. It doesn't care about innovation, technology, or military reach. The pattern is mathematical, and mathematics is indifferent. Some will insist this time is different. They'll point to the strength of the U.S. economy, the size of its capital markets, Silicon Valley, the dominance of American tech. They'll argue the dollar is too entrenched to fail, that alternatives don't exist, that central banks will find a way. They're mistaken. Every empire heading toward collapse believed it was unique. Rome believed it. Weimar Germany believed it. The British Empire believed it. All of them were wrong. Belief in exceptionalism isn't proof of stability. It's a signal that stage 3 is already well underway. It's proof that the illusion still holds. But illusions don't stop mathematics. They only postpone recognition. Others will argue that modern monetary theory, central bank digital currencies, or new financial technologies will rewrite the rules. That innovation will let us escape the consequences this time. That's optimism disguised as expertise. The instruments evolve. The underlying pattern does not. You can't print your way into prosperity. You can't borrow your way out of debt. You can't escape debasement through software. Not with algorithms, not with computers, not with blockchain. The reset is coming because the structure requires it. So the question becomes, what do? You step outside the system. You hold assets that survive resets. Physical gold, silver, real stores of value that don't rely on government promises. You recognize that wealth isn't measured in the currency of a failing framework. You stop thinking in dollars and start thinking in ounces. You stop assuming central banks will protect you. And you start protecting yourself. This isn't about getting wealthy. It's about avoiding destruction. Most people won't grasp that until the moment it's too late. They'll watch gold climb and dismiss it as a bubble. They'll see central banks pulling their reserves home and chalk it up to nationalism. They'll feel rising prices and blame corporations. And when the reset arrives, they'll be stunned, disoriented, and unprepared. Don't be most people. The mechanism is already running. Central banks are repositioning. The debt trajectory is untenable. The currency is being diluted. The pattern is nearing completion. The only real question is whether you recognize it. A $10,000 gold repricing isn't fantasy. It's the mathematical consequence of a system that has already crossed the point of no return. This isn't the first reset, and it won't be the last. But it will be the most consequential in modern history. Because when the reserve currency resets, the entire global order resets with it. Those who understand the pattern will be the ones who endure. If you want to understand how this architecture was built, how central banks amassed their power, how a system emerged where money is created from nothing and supported by debt. Keep watching. If you want the steps to protect yourself, the assets to hold, the pitfalls to avoid, the timeline we're tracking, subscribe now. This channel exists to decode the pattern, to expose what sits in plain sight, to prepare you for what's coming. The reset isn't decades away. It isn't years away. It's unfolding now, quietly, beneath the surface. And once it erupts into view, preparation time is over. Don't wait for permission. Don't wait for confirmation. Central banks have already revealed their judgment. They're buying gold. They're moving gold. They're preparing for a reset. The question is, are you?